There are companies in the world that do not own massive factories, sometimes do not generate large profits for years, yet are worth more than the economies of entire countries. At the same time, there are thousands of businesses that work honestly, sell real products, and generate stable income, but never create massive capital. Why does this happen? Because in the modern economy, big money is created not only through labor and not even only through profit. It is created through scale, systems, technology, market control, recurring revenue, and a company's ability to grow faster than its expenses. This is the real nature of corporate economics. So, in this lesson, we will explore how company valuation is created, why investors value businesses the way they do, how the mechanism of corporate value works, and why the world's largest fortunes are built through equity rather than salaries. Let's begin. What is company capital, really? Most people think very simply. A company is worth as much as it earns. But the real economy works much more differently and much more complex. When investors evaluate a company, they do not look only at the money it makes today. They evaluate how fast the business can grow, what potential it has, whether it can dominate a market, how scalable its business model is, and whether the company will be able to generate much larger profits in the future. That is why sometimes a small technology company can be worth more than a huge traditional business with factories, employees, and stable profits. Because the market does not buy the past, the market buys the future. And this is where the concept of capitalization truly begins. So how is massive company valuation actually created? Large fortunes do not appear by accident. Behind them, there are almost always specific economic mechanisms. And the first one is scalability. 1. Scalability, the foundation of great companies. There are businesses that can grow only linearly. For example, if a restaurant wants to earn more money, it needs more tables, more employees, more space, and higher expenses. In other words, every new stage of growth becomes expensive. Now compare that to digital companies. Software can be created once and sold to millions of people. That is why companies like Microsoft, Spotify, or Netflix can serve hundreds of millions of users without their costs growing proportionally. One algorithm can work simultaneously for the entire world. One platform can serve hundreds of millions of users with only minimal additional costs. That is why technology companies grow much faster. Their entire economic model is built on scale, and the easier a company can scale, the more valuable the market considers it to be. 2. A large market equals large potential. But even the best company cannot become a giant without a large market. Investors do not evaluate how big a business is today. They evaluate how big it can become. That is why they always ask, how large can this company become in the next 5 to 10 years? A local business has natural limits. For example, a small cafe can be very profitable, but it is difficult to scale it across the entire world. Now look at global platforms. Companies like Amazon, Apple, Google, Microsoft, and Meta did not build businesses for one city or one country. They built them around global demand. And a global market represents tens or even hundreds of billions of dollars in potential value. That is why the market places such high valuations on companies that can operate internationally. 3. Why do investors love recurring revenue? Because the market strongly dislikes instability. If a company constantly does not know how much it will earn, whether customers will return, or whether sales will exist next month, the business becomes risky, and risk reduces valuation. That is why the modern economy loves subscription-based models so much. Netflix, Spotify, SaaS services, and cloud platforms are all examples of recurring revenue models. In other words, income that repeats again and again. For investors, this looks far more stable. And in the financial system, stability almost always means a higher company valuation. 4. Network effect, the most powerful force of the digital economy. And now we come to one of the strongest mechanisms of the modern world, the network effect. Its logic is simple. The more people use a system, the more valuable it becomes for everyone else. For example, Instagram without people makes no sense. Uber without drivers and passengers does not work. YouTube without creators is an empty platform. It is the network effect that creates dominance, rapid scaling, enormous barriers for competitors, and colossal amounts of capital. Because when a system becomes large enough, it begins to grow almost by itself. And this is exactly why the world's biggest companies are often platforms. 5. Intellectual capital, the new foundation of wealth. In the past, the greatest value came from land, factories, resources, and production. Today, the situation has changed. In the modern economy, a company may not own huge real estate, factories, or thousands of physical products, but it may have code, AI models, algorithms, a brand, patents, an audience, and technology, and still be worth billions. The world has moved from physical capital to intellectual capital. And this is one of the biggest economic changes of the 21st century. How do company founders become billionaires? Here is the point many people do not understand. The richest people in the world rarely become rich through salaries. They own parts of systems that grow. That is why founders can receive relatively small salaries for years, but still become billionaires through the growth of their company's value. When a company increases its capitalization, its shares become more expensive, equity grows, and the value of the founder's stake increases. So the main wealth is created not through cash, but through ownership of a growing asset. That is why entrepreneurs, platform founders, investors, and technology owners create the largest fortunes in the world. So, large amounts of money in companies do not appear when a business simply sells something. They appear when a company can scale, operates in a large market, creates recurring revenue, builds strong systems, uses network effects, accumulates intellectual capital, and grows faster than its own expenses. This is what creates capitalization, massive valuations, equity, and corporate wealth. Let's sum it up. Modern capital is not created simply through work. It is created through systems that can scale faster than their costs grow. We live in an era where a single idea can become a billion-dollar company, where one algorithm can serve the entire world, and where the main value is not just a product, but a system capable of growing almost without limits. But it gets even more interesting, because now we move from the level of companies and systems to the level of the individual, to how capital is formed not at the corporate level, but at the personal level. What determines your value in any economy, regardless of country, market, or time? Subscribe and stay with us. See you in the next videos.